Welcome back to Investing Talk Podcast. Today, we're zeroing in on Canopy Growth, a company that's, well, really been on a volatile journey in the cannabis sector. Our goal here is to sift through a stack of recent financial reports, market analysis, expert commentary, basically everything you've shared with us. We want to give you a clear, concise picture of where Canopy Growth stands right now, especially with earnings potentially around the corner. We'll pull out the most important pieces of information so you can quickly get up to speed on what's, really driving the stock. And before we jump in, if you like what you're hearing, please do remember to subscribe, hit that like button, maybe leave a comment. Your support genuinely helps us keep bringing you these analyses. And hey, if you're feeling extra generous, you might consider buying us a coffee. The link's usually below. Also, if there's a specific company you want us to look into next time, definitely drop it in the comments. We do read those. Okay, let's unpack this. Canopy Growth. They've definitely been making some big strategic moves lately, looking at the sources, what's the headline on their latest financial performance, and, well, their overall health.
Well, the main thing to grasp about Canopy right now is that their financial picture is really a mixed bag. If you look at the full fiscal year 2025, their net revenue actually dropped about 9% year over year. And Q4 FY 2025 specifically was down 11% compared to the same quarter the year before. So that's, a clear headwind. But the story underneath is a bit more nuanced. They've shifted their product mix more towards higher margin Canadian medical cannabis and also their stores and Bickle devices.
The vaporizers, right. Those are pretty well regarded.
Exactly. And that shift shows up a bit in the Q4 gross margin. It was 16% or an adjusted 19%. And here's maybe the brighter spot. Despite an operating loss from continuing operations of $18 million, that's actually an 83% improvement compared to the year before.
83%. That sounds like a huge improvement, but they're still losing money on operations. Is it really a turnaround sign or just less bad?
That's the right question to ask. It is less bad, but it perhaps shows a direction, right? And what's interesting is the very latest quarter we have data for, Q1 fiscal 26, ending June 30, 2025. In that quarter, consolidated net revenue actually went up 9% year over year.
Okay, so a reversal from the full year trend.
Exactly. It suggests some momentum is building, especially in the Canadian adult use market, which is super competitive, and they're seeing steady global medical sales too. Now, management keeps talking about achieving adjusted EBITDA profitability.
Right, the adjusted figure. Always got to watch those.
Absolutely.
Yeah.
You have to remember, adjusted EBITDA is non-GAAP. It excludes real costs like stock-based compensation. It's a measure of operational efficiency, maybe, but it's not true net income. And historically, their actual earnings per share, the EPS, is still firmly negative. We're talking minus 94 cents in March 25, minus 76 cents December 24, minus 95 cents September 24. It just highlights that even with some operating improvements and that recent revenue bump, they are still losing money overall. Burning cash. Got it. So glimmers of operational progress, recent sales growth, but still deep in the red on the bottom line. What about the bigger picture? Debt, cash flow. That seems critical here.
Yeah, and this is actually where Canopy has shown some significant progress, believe it or not. Management reported really substantial deleveraging through fiscal 2025. They cut total debt by $293 million.
Wow, okay. How much of that percentage-wise?
That's a 49% decrease, almost half their debt load.
That's pretty aggressive.
It is, and it's a strategic positive, right? It de-risks their balance sheet quite a bit, maybe gives them more flexibility, even if profitability is still off in the distance. They've also been really focused on cost cuts, which help bump the full-year gross margin up to 30% from fiscal 24. But like we said, these actions narrowed the operating losses, but the business isn't cash flow positive yet. More money's going out than coming in from operations.
Still burning cash then? Still burning cash. They're targeting more cost cuts and margin improvements in fiscal 26. Some third-party sources mention liquidity metrics, like a current ratio around 3.1, debt to equity near 0.62. That suggests they have enough liquid assets for the near term, but it doesn't fix the underlying profitability or cash burn problem long term. The question is, how long can they keep going without positive cash flow?
That's the million-dollar question, or maybe $1 billion in this case. So cleaning up the books, but the engine isn't self-fueling yet. How are they doing competitively? Canada, internationally? It's a tough market.
It really is. In Canada, Canopy says they're gaining share in the popular adult use categories. That's actually pretty good news, given how crowded and price-sensitive that market is. They're also boosting their medical mix, which usually has better margins. Internationally, they've got their medical cannabis footprint and, of course, the stores and Bickle devices, which are a strong point. But international growth can be, well, unpredictable. Q4 fiscal 25 saw declines in both international cannabis and device revenue, so it's not a smooth upward curve.
Right, highlights the volatility.
Yes, exactly.
Hmm.
Their stated focus is on better execution, targeting those higher margin bits, and simplifying their product lineup. Basically, trying to get profitable in a really fragmented and challenging global cannabis space. It's a shift from just growth at all costs to aiming for profitable growth.
Makes sense. But pivoting to profit when you're still losing money, that's tough. Which brings us to valuation. How on earth do investors value Canopy growth with negative earnings? Traditional metrics must be useless.
That's exactly the problem. It's fascinating, actually. With those persistent negative earnings, the classic price to earnings, or PE ratio,
Yeah.
totally meaningless. It's either negative or infinite. Tells you nothing.
So what do people look at?
Well, often they fall back on things like price to sales, PS, how much are you paying for each dollar of revenue, or price to book, PB, comparing the stock price to the company's net assets. Some recent commentary mentioned an enterprise value around $7.96 billion and framed it as roughly 70% price to sales. But you have to constantly double-check those figures against the current market cap, cash, debt, because the stock price bounces around like crazy, and currency matters too. Given the ongoing losses and those thin, shaky gross margins, Canopy usually trades at a discount compared to, say, profitable consumer staples companies. And even compared to other cannabis players, its multiples are just wildly volatile. It really highlights the speculative nature of this whole sector. You're often betting on the future, not the present.
Right. So standard PE is out. What about fancier models like discounted cash flow, DCF? Can you even build a reliable one here, or is it pure speculation?
Building a reliable DCF for Canopy growth is, well, it's severely constrained.
Because there's no positive cash flow to discount?
Precisely. A DCF needs projections of stable positive cash flows way out into the future.
Mm.
For Canopy, the path to sustain positive EBITDA, let alone positive free cash flow, which is what really matters for valuation, is just super uncertain. Plus, you've got huge regulatory question marks, especially around the U.S. market. That could totally change things, but it's impossible to predict reliably.
So the inputs are just too fuzzy.
Exactly. Too many what-ifs. So relative valuation against Canadian peers often ends up looking at revenue multiples, maybe factoring in the device business. But that lack of consistent profit and the high volatility mean models really struggle to give you a credible fair value range. Now, if management actually hits that fiscal 26 adjusted EBITDA profitability target, that could compress the perceived risk and maybe support higher multiples.
Big if, though.
Huge ifs. It's very execution dependent and makes investing here feel much more like a speculative bet than something based on solid fundamentals right now.
Okay, that paints a clear picture of the valuation challenge. So how has the stock itself been behaving amidst all this financial complexity and valuation fog?
Well, as you'd expect, Canopy growth has a history of really sharp swings, usually driven by news. For example, back on August 11, 2025, the stock plopped intraday by something like 20%.
20% in one day. Wow.
Yep. That was right after their Q1 fiscal 26 update and some positive headlines. It just shows you the level of trading interest and, likely, some short covering kicking in.
People betting against it getting squeezed out.
Exactly. That can amplify moves. Given this kind of volatility, trying to pinpoint exact support or resistance levels is less useful than thinking in broader trading ranges. Active traders might look for support in recent consolidation areas after those spikes, and maybe resistance near previous peaks within the latest range. But it's a fast-moving target.
Definitely sounds like it. Beyond just price action, any technical indicators traders might be watching? Signals for momentum or reversals?
Oh, absolutely. After that big earnings spike, momentum indicators definitely shot up, probably pushed things into overbought territory on shorter time frames.
Meaning a pullback might be likely?
Potentially, yeah. But the overall trend is still pretty fragile. The medium-term direction really depends on whether they get follow-through buying after earnings and what the next catalysts are. Traders often watch key moving averages like the 20-day and 50-day to gauge the trend, and oscillators like RSI, the Relative Strength Index, or MASD, Moving Average Convergence Divergence.
Right, standard tools.
Standard tools, yeah.
Yeah.
They look for overbought, oversold signals, maybe signs the trend is losing steam, potential reversals. And this is critical, the volatility here is so high. That means the risk of false signals like fake breakouts or sudden sharp reversals is much higher than with a steadier stock.
So technicals can help, but you need to be really cautious.
Extremely cautious. It's not a stock for set and forget trading based on signals alone.
Gotcha. So charts show high volatility. Stepping back, what's the latest news flow and just the general market buzz around Canopy growth right now?
Well, recapping, the Q4 FY25 results show the better operating loss and the cost cuts, but also that revenue decline. Kind of a mixed message. Then Q1 FY26 came with that 9% revenue growth, and management really pushed the narrative on expense control and the path to adjusted EBITDA profit.
So improvement on the top line, but still talking about getting to profit.
Right. Most trading outlets called it a mixed bag. Strong top-line number, but still negative on the profitability metrics. That kind of mix fuels speculative interest. We don't have specific analyst rating changes in the source material, so you'd need to check your own broker platform for the very latest takes there.
Okay. What about insider trading or social media sentiment?
No info on insider trades in these sources. As for social sentiment, yeah, around that August price surge, things definitely skewed bullish in online trading circles. Lots of momentum chasing. But you know how that goes. That kind of sentiment is super fickle. It can turn on a dime based on the next headline, good or bad.
Very true. Okay, looking ahead then, what are the key things, the catalysts that could really move Canopy Growth's stock? Short term and maybe longer term.
Short term, the big one is obviously their next quarterly results for fiscal 26. Everyone will be watching that adjusted EBITDA number, any more progress on margins, Canadian market share, and anything related to Stores and Bickle, new products, sales trends. That's a key asset. The stock is also super sensitive to any regulatory news, right? Anything affecting their U.S. plans, like rescheduling or shifts in international medical markets.
So earnings and regulatory headlines are key short-term drivers.
Definitely. And just momentum itself. Sometimes these stocks move just because the sector is hot or there's a specific news catalyst that gets traders excited. Longer term, the really big potential catalysts are regulatory shifts in North America.
U.S. federal action.
That's the big one. Federal rescheduling or broader legalization could open up massive opportunities. Also, state-level expansion continues. Beyond regulation, you'd look for stabilization in the Canadian market, real growth internationally in medical cannabis, continued success in paying down debt, and crucially, actually achieving sustained positive adjusted EBITDA, and then eventually positive free cash flow. That would be a game changer for their valuation.
But those are still big maybes, heavily dependent on things outside their control, too.
Absolutely. Very dependent on both their own execution and policy shifts.
Right.
Huge uncertainty remains.
Okay, so potential upside catalysts. What about the flip side? What are the biggest risks investors really need to keep front of mind with Canopy Growth?
Well, number one is the risk tied directly to their financials.
Yeah.
Continued net losses and that ongoing cash burn. If they can't turn profitable, they'll need more money eventually. That leads to execution risk. Can they actually hit those cost cut and margin targets? It's not easy.
And we saw revenue can be volatile too.
Right. Volatility in device sales, international sales, that makes planning harder. And then there's potential dilution risk if they have to issue more shares to raise capital. That hurts existing shareholders. Plus, they're still heavily reliant on regulators in multiple countries doing things that are favorable, or at least not unfavorable. And just the fact that their performance bounces around quarter to quarter underscores how uncertain that path to consistent profit really is.
Makes sense. What about broader market or sector risks?
Oh yeah, those are significant too. The Canadian market is still tough, intense competition, prices getting squeezed. That pressures everyone's margins. Regulatory unpredictability isn't just a Canopy issue, it affects the whole sector, U.S. and globally. Policy can change quickly. Access to capital can also be tighter for cannabis companies compared to other industries. And fundamentally, that super high share price volatility we talked about, it cuts both ways. Any bad news or even just negative sector sentiment can hammer the stock price really hard, really fast. It's a high beta, high risk sector overall.
Okay, a lot to weigh there. So putting it all together, what does this analysis mean for you, the listener, maybe trying to make sense of Canopy Growth? Your sources gave an overall rating.
They did. Based on everything, the overall rating comes out as a 4 out of 10.
A 4 out of 10. Okay. What's the thinking behind that specific number?
Well, the rationale is acknowledging the positives. They are showing better cost control, that debt reduction in FY25 was significant, and Q1 FY26 did show top-line growth. Plus, management is targeting profitability. Those are constructive steps. However, the company still consistently loses money on the bottom line. Gross margins are thin and variable. They face huge execution challenges in a tough market with regulatory uncertainty everywhere. And as we discussed, valuation is really hard to pin down without positive free cash flow. Add in the extreme stock volatility, and you get to that 4 rating. It reflects potential, but also very substantial risks.
That's a very clear breakdown. It leads to a really important question then. Based on this analysis, what's the recommended investment horizon here? Is this a long-term hold or something else?
Yeah, based on what we've reviewed, Canopy Growth currently looks better suited for short-term trading rather than a long-term buy and hold investment.
Why that distinction?
Because the momentum, the news catalysts, the volatility, those can create opportunities for nimble traders who understand the risks and can manage them. But for a long-term investor looking for fundamental value and stability, until Canopy demonstrates sustained, adjusted EBITDA profitability and, more importantly, a clear, believable path to generating actual positive free cash flow consistently, the long-term risk-reward profile just remains really uncertain.
So speculative potential for traders, but still too much uncertainty for long-term investors right now.
That seems to be the takeaway from the current analysis. Yes, it's still very much in a transitional, highly speculative phase.
That's a critical point for anyone looking at this company. Well, thank you for walking us through all that complexity. Hopefully, this has given everyone listening a clearer, more nuanced view of Canopy Growth Corporation. As always, don't forget to subscribe, like, and comment if you found this useful. Let us know if there's another company you'd like us to examine. Until next time, stay informed and make smart choices.